Welcome back to the channel. My name is Steven. I'm a pharmacist. I own 52 units of real estate and I help coach people to buy their first multifamily deal. So today I want to give my thoughts about the 2025 real estate market. Today is June 19th, 2025. And kind of these have been my thoughts after observing the market. So I feel like a lot of buyers and sellers are kind of at this weird standstill because interest rates are so high. And I feel like every quarter or every month, people are waiting for the news. Well, the Fed lower interest rates. And, for now, it's always been like interest rates have stayed the same or interest rates have gone up. And because of that, it's been creating a standstill, like single family homes. Housing prices haven't really gone down and interest rates are still high. So, people thought when interest rates went up, at least in California, that housing prices would go down, but that hasn't been the case. Housing prices have just stayed the same, but interest rates have gone up, so it's hard to qualify for homes unless you have a large down payment, unless you have a really high income W-2 and a really good credit score. But it's a lot harder to qualify for loans today at 7 to 7.5% interest versus back when homes were you can buy a home for like 3.5% interest. So because of that, it's harder for buyers to qualify. So a lot of buyers will fall out of escrow because they don't qualify with the lender, and a lot of sellers who want to sell, they may have locked in a great interest rate of 3% or less, and they want to sell at a higher price, but they're finding out there's not as many buyers and people aren't overbidding anymore. So now, at best you'll get is your asking price, and then you might have to give some concessions. Like you might have to give some repair credits. You might have to give some buy down the interest rate to make the interest rate a little bit more reasonable. So there's a lot more negotiable now versus when it was a seller's market and you can get what you want, get over asking, and it'd be a crazy bidding war. So that's how I've kind of seen it with the single family side, at least in California. And then in Huntsville, Alabama, what I've kind of seen is that they've overbuilt in Huntsville, Alabama, and they continue to overbuild. And this is because a lot of people got construction loans during COVID, so during 2020, 21, 22, 23, and now these projects, whether it's single family home developments, apartment complexes, are now finally going onto the market. So all of a sudden there's an excess supply of housing, and these apartment complexes are giving concessions. You can live there for 2 months free. They'll give you half off rent for the first like 4 to 6 months. There's a bunch of incentives that they're giving because these apartments are owned by investors and they want to be able to fill up these units as fast as possible and then present it to a lender to do a cash out refinance to get out of their variable interest rate debt. Because a lot of the builders, they have maybe a 5-year term or a 7-year term, and it's a variable interest, and right now it's probably like maybe, I don't know, like 10, 11, 12%, and they want to get these units filled up to do a cash out, get a new financing in place, more stabilized financing in place, and lower their interest rate to like maybe 7.5 to 8%. So they're very motivated to get rid of these units fast. And when there's excess supply like that, that's why I've seen rents drop in my single family home in Huntsville, Alabama. And so that's all I've kind of seen in terms of rentals. But in terms of like selling, there's so much new construction in Huntsville, Alabama. Like Lennar has a bunch of new construction. D.R. Horton, these big national builders have so much supply, and they're, like I said, desperate to get rid of the new construction because they have to meet their quarterly goals. So they'll give you repair credits. They'll give you cover closing costs. They'll buy down your interest rate. They have connections of lenders and buy down your interest rate to get it at a 5% interest rate, so it's more affordable. So because of that, like, why would you buy a home that's like 5 years old for, let's just call it $200,000, when you can buy a brand new build for $230,000? Yes, it'll be smaller in terms of square footage, but it's brand new. You can customize your backsplashes, you can customize your flooring, you get the 1-year warranty, and they're willing to buy down your interest rate to like 5%, cover your closing costs, prepay HOA for a year or two, whatever that looks like, right? They might give you appliances, they might cover your blinds. There's a lot of incentives that they can give you. So why would I buy an old house for like 20K less when I can buy a new house for 20K more, get incentives, and it's that 20K is just leveraged over 30 years. So it's not that much more in terms of cost. So it's difficult for those people who own those homes in areas that have been overbuilt. So like Austin, Texas, Huntsville, Alabama, Dallas, Texas, like these areas. So I think buying targeting new construction or homes that have been purchased within the past like 5 years, because they're competing against the new construction. So either buy the new construction, obviously you're going to put a large down payment to make it cash flow at a 7% interest rate. But if you can put a large down payment, you have the liquidity, and you don't mind the large down payment, and you can buy on interest rate, you can buy this property and have it cash flow and hold on to it long term, right? So that's option A. You can buy really good new builds if you have a lot of liquidity and you have money for a down payment. If you don't have money for a down payment, or you want to leverage more, you could target these homes that are 5 years old, that locked in a great interest rate of 3% on average, and they're forced to sell because they're in a more desperate situation. Maybe they inherited the house from a parent who passed away. Maybe there's a divorce and need to sell. Maybe they got laid off and they need to move. So they're in a more desperate situation, but they don't need the money today. In which case, you can take over the loan subject to, and then do a seller carry second, so that you can put a low down payment, and you can assume a great interest rate, structure the seller financing so that you can still cash flow, and you know what the rents are, and then you can still own this property with no to low money down, and have it cash flow, and then hold it long term. So I'm in that camp right now, because I want to keep my liquidity for a big apartment complex that my next one that I want to buy. So I'm trying to get these deals, but obviously it's a very niche deal. Like I said, it has to be bought within 2020, 2021, 22 ideally, maybe 2019. They have to be in a desperate situation, and they have to be open to doing seller carry second, because they don't need the money immediately. So they're in a desperate situation, but they don't need the money immediately. So I'm waiting for that pain. And I've made multiple offers, and they got rejected, but it's just a numbers game and a patience game, and you got to follow up over time. So that's kind of the strategy that I've been using. So that's what I've kind of seen. So, kind of stepping back, and then in terms of my C-class apartments in Oklahoma, I feel like the rents have been kind of stagnant, if not going down a little bit. I noticed in my 20 unit, at one point they're renting for maybe $550, but now I noticed it kind of cooled off a little bit, so maybe it's $450 to $500 to keep the units full and occupied. But my property managers are good at kind of gauging the market and kind of adjusting as needed, because it's nice just to get the tenant in, and then once they're in, and assuming they like the place, you can just gradually raise the rents over time. So I've kind of noticed in Enid, Oklahoma, which is a more secondary market, rents have gone down a little bit. In Oklahoma, the rents have kind of stayed a little bit stagnant, right? But the downside is my insurance went up, my property tax went up, my expenses went up. So if my rents are the same or a little bit less, and my rents went up, my NOI went down, and if my cap rate went up, that's a double whammy. My value of my apartments are going down, right? So knowing that, for me, I'm not losing money if I don't sell, but knowing that, a lot of other apartment owners are being hit with the same thing. Their expenses are going up, their income is staying the same or being stagnant. The interest rates are up, which means cap rates are up, which means values are down. So if I can swoop in and get another amazing 20 to 30 unit apartment complex from a desperate seller, then I could buy it, renovate it, fix it up, stabilize it, hold onto it long term, and then that'll be the next apartment I need to probably comfortably say, hey, I don't need to work anymore once it's stabilized. So that's my goal for the next 5 years, to get one more apartment like that I just can stabilize and own it long term, right? So I just need to buy it right. So the key is buy it right. So I gave all this information, but the key thing is you just have to buy right, and buy in a way it makes sense for you in terms of cash flow. So for me, to me buying right means I want to do a low down payment or minimum down payment. So that's 25% down. Or if you do seller financing, it's about 5 to 10% down at most, or maybe 5% down, right? So for me, it's minimum down, because I want to leverage and I want to be able to cash flow despite that. So if I do seller financing, you can negotiate accordingly, and I want the ability to be able to be in a good area, have population growth, job growth, diverse job incomes, diverse economy, and a good tenant base, and then own that long term with one of my property managers that are already managing my properties. And then that's kind of my criteria. So it's very specific and it's very hard, but when I do find a property in that criteria, I make my offers that make sense for me. And oftentimes it's 30-40% less than what the seller wants, and at that point you give them the offer, the ball's in their court. They can say yes, they can say no, they can say no, but then that means just follow up later. So that's kind of what I've been doing, right? It's if you think the market's going to crash 30%, well, just offer 30% less now. Be ahead of the curve. And maybe when they get more desperate, they'll be more open to your offer. So it's just putting in the work, making offers that make sense for you, which is 30 to 40% less than what they're asking for. And just know that's a numbers game. So just have your criteria, have your very clear buy box, and make offers on your buy box on offers that make sense for you, right? Like if I was willing to put larger down payments, I would just buy new construction all day because I know I can rent these out. But right now I don't want to put a large down payment because I'm saving that money for my next apartment complex. So, I'm specifically limiting my buy box because it gives me crystal clear. But when I see it, I'll strike, and I know that I won't get as many deals. If I was just buying new construction, I can buy one every month because there's so much supply. So, anyways, just want to share my thoughts on the housing market. Hopefully you gain some value. Let me know if you have any questions or comments. If you want mentorship and one-on-one coaching, click on my link tree. From there, you can see the links to that. You can also send me an email if you want a discount code. Otherwise, please like, comment, subscribe, and hope to see you next one. Thank you so much.